Karan Aggarwal, co-founder and CIO of Elever. Karan, hi, good evening. Welcome to the show. Karan, let's just first begin with the normal understanding of investment. You know, we've seen a lot of change in investor behavior, talking about young investors and their typical understanding of SIP, SWP, direct schemes or regular schemes. What's the kind of change and what are they actually looking for?
See, basically, if you look at SIP, that's a classic tool of time diversification. Okay. So in general, if you are investing money, let's say you are going for lump sum investments, let's say in 2007, December 2007 at peak, just before global financial crisis in 2008. Okay. So you would have recovered your money by 2010. But had you gone for SIP in Nifty 50, you would have done the break even way back in April 2009. Basically, that's because the average buy price goes down by 50%. Every dip you are buying something, you are making some money. And on the other hand, there is a downside to SIP as well. Uh, because the issue is that in the bull market, okay, because you are going for time diversification and you are buying at each every new high, okay, at after some time, stepwise approach. So there your buying cost increase typically, and you lose out on certain returns. So most of the young investors these days are looking at different avenues to basically to enhance the returns from their SIP process and protect against this opportunity cost in the bull market. And they are increasingly looking at factor funds. We have seen a huge explosion in factor funds in last 4 years. Nearly 100 products are out there which are tracking different factors like low volatility, quality, momentum, alpha, value, and even there's customization on a small cap side as well. So what is the quality with factor funds? You are getting higher risk adjusted return. So let me give you an example like of a low volatility fund. So if you look at the track record of low volatility index fund, it has given nearly 18% returns, a CAGR of 18% over the last 20 years, vis-a-vis 15% for Nifty. Okay, so there's a 3% annualized alpha that we are looking at. Best part is that despite giving higher returns, the risk that investors are exposed to is relatively lower. During the downside, like 2008 crisis, even in 2011 crisis, these funds reduce the downside by around 33%. So this is a risk return anomaly that basically add to risk adjusted return of the portfolio. So most investors who are looking at large cap funds, relatively lower spectrum of the equity, okay, they are moving towards a low vol, quality, dividend, these kind of factors. On the other side of risk spectrum, if you look at mid cap and small cap funds, you see the small cap funds are typically risky. You are going beyond top 250 companies, okay, to get the returns. So instead, if you go with momentum and alpha, which are relatively higher risk segment in factor investing, you can see that these funds have outperformed these small cap funds over the last 20 years. If you look at momentum and alpha, CAGR is around 20%, okay, as compared to 16 to 18% for small cap and mid cap funds. And best part is that these small momentum and alpha strategies, they are exposing you to only large cap and mid cap securities. There is no small cap exposure. So you are getting these additional returns at lower risk. So these products are getting popularity among young investors. The other aspect that has basically lended some credibility to these factor funds is the fact that there is no fund selection risk here. Typically, when you are going for large cap, mid cap, or even flexi cap funds, you have to select the fund manager. Okay, and so that's a very difficult exercise because ratings and rankings are also not very consistent. Okay, but here in factor funds, returns are practically same. They are tracking the same benchmark. Okay, most of the factors have their set benchmark. They are tracking it. So fund selection is not there. Here you have to decide how much risk you want to have. Okay, and accordingly you can select a factor and build your portfolio. So it's relatively much more easier than traditional asset allocation models. It's really easy. If you're for DIY investors, it's relatively much more comfortable to build the portfolio, convenient to build the
Right.
portfolio.
Um, Karan, I also want to understand the landscape of international investing. Now, looking at the
Mhm.
surge of investors, talk about we can call them young investors, millennials, Gen Zs, or whatever. How is international investing scenario? What are the countries that these investors are preferring? What are we looking at? What is the route of investment also that we are looking at? What are the specific sectors or categories that we are looking at as far as international investing exposure is concerned?
See, when it comes to right now, when it comes to international investing, we see how the markets are behaving relatively. Okay, what is the potential, return potential that you look at when you look at US market, European market, and compare it vis-a-vis Indian market. So as of now, Indian market is in a growth sweet spot. Okay, so you are looking at it. You basically your home market is expected to double the GDP every 7 years. Basically we are assuming 10% nominal growth rate. Okay, so and in next 15 years you are expecting 5 trillion market cap that is a market cap of Indian equities that is expected to shoot up to 25 trillion. Sorry, 5 trillion to 25 trillion. So you're looking at really 5x returns in next 15 years. Okay. So, but when you look at the global markets in general, to global markets, we are looking at the slice which is missing in Indian story. Okay, so like if you look at the US market, there's NASDAQ 100 that provide exposure to technology there, technology sector there. Okay, the innovation slice, you look at the AI, IoT, Apples and Googles of the world, cloud computing, cyber security, the key themes, key technological themes, that particular exposure is missing in Indian market. Indian market, even today, Indian market is largely consumption, services, or there is a bit a shift of manufacturing export. We have seen in recent years some focus on manufacturing export. Okay, so that is a missing slice, the innovation slice that is missing, and we see US market as a source to add that innovation slice to our portfolios. Okay, apart from that, if you look at the markets like in Europe and China, you see that they are trading at significant discount to Indian market. There are many reasons for that. EPS growth is stagnant. If you look at Europe, GDP growth is zero for almost last 3 years. China is also struggling to grow. There might be some fundamental reasons for that. But having said that, some of these markets are trading at extremely huge discount to Indian market. Okay, so there are some opportunistic value opportunities that you can see. Okay, you can look at you can look at Europe. Europe is trading at nearly 50% discount to US market. Okay, and there are exciting opportunities there in the defense sector. Okay, even the manufacturing sector. Okay, they are also trying to do their own like Trump has done the tariff tantrum, okay, trying to increase the manufacturing base in US. These countries are also looking to build their export base. Recently, German government has given, just today, German government has given the stimulus to boost the manufacturing and defense industry. Okay, there would be a decoupling of, basically, if you look at the NATO charter, you're looking at Europe increasing. Europe, most of the European countries spend nearly only 5.5 to 1% of their GDP on defense. This share is
Right.
expected to increase to 2 to
Right.
2.5.
Right.
As
Right, Karan.
yeah.
Okay.
So 2 to
All right.
2.5 as yeah.
Sure.
Go on.
Sure. 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 All right. I do have a lot of questions for you, but then my time is up for this particular discussion today. Thank you so much for being on the show and helping our viewers understand the landscape of young investors and their investing trends. Thank you.